This short clip is from my live trading room. You can engage directly with my fabulous team and me at LaDucTrading.com for all our research and trades. Or for just my daily live streams, you can access via YouTube memberships. All links are in the description. Why, besides all the headline risk, are we holding so well? It isn't the CTAs. They're not selling. They're also not buying. The dollar is not rising. 10-year isn't above the 4.33. Oil is very, very risk off, but it has a collateral damage feel that kind of slowly then all at once. The market still believes after 6 weeks or whatever that this is going to resolve itself. Trump is going to prevail or Iran is going to cave. Either way, and I don't believe in either of those scenarios, as you know, because I've been writing about this for 2 months. Anyway, the point is, why is the market still able to do this besides flows? Earnings. Morgan Stanley still is pushing, and bulls are still pushing the AI narrative, number one, and the moats of cash around these Mag 7 plays. The forward price earnings, if you're a valuation trader, you know that there's some stuff on sale right now, right? NVIDIA hasn't been cheaper. The forward price earnings have fallen 15% from the October highs. And by a lot of folks, that's a sale. They want to buy it when it's on sale. And then we bid it back up with a combination of flows and fundamentals from an earnings report. And then basically that growth scare is priced in. Everything's on sale. Valuations have compressed. Okay, it's on sale. Why are they so excited? Because they still see growth expectations ahead. This PE multiple game suggests that folks' funds have already de-risked. They didn't have a tail event. They just de-risked underneath the surface for months. Stuff I've been talking about. So now you have earnings coming in, and you would think that there is an EPS growth slowdown. There isn't. Valuations still are optimistic. So the market's having a hard time pricing in earnings contraction from this war because they don't know how long it's going to last. And earnings are still growing in expectations, not falling. And until that changes, the market's not pricing that in. We had our overshoot here to the downside. I had given SPX 64.1654 for a price target. Remember that? Well, we overshot by 1 day and then ricochet rabbit into end of quarter, fund flows and JP Morgan and all that jazz. Boom. We firmly closed on the 31st at 65.28. You can see over here on the monthly, 65.28. Where did we open today? 65.87 and change, above 65.82 and change. So this is your channel. 66.30.70 is for SPX resistance. We get above that, we're heading to the 10-week. We fail 65.82. We're heading back down to 65.32, 6,500 time frame. So this is where the 50-week is supposed to support the market. We had an overshoot, we got back above it. So now you're just kind of stuck. You need this to break. You need this to break out. So I still see this 200-day coming into view. We already talked about the 21-day tag, you're it. Supported. Now we're pushing. We're just pushing into 66.30, 66.50, basically 66.66. Wall Street, they're still excited about AI and they've de-risked, and duration of the oil crisis is not priced in, and we don't have the headwinds of dollar and yields moving higher, which are a much bigger risk to equities. So we don't have right now, let's just say, a bullish backdrop, but we haven't rolled over yet in a credit, private equity and private credit. They've already been weakening under consumer lending since September, problems since September, October. We've had valuation contraction since October. We've had Mag 7 sell-off of size since October. So now we're in this stabilization period as we go into earnings. It's boring sometimes, and we're in that boring period, no question.
Join Club to trade with Samantha. Scan this QR code or click the link in the description.